In Chapter 12, we take information from previous chapters and work to calculate a company's weighted average cost of capital. The company's cost of capital is generally used as their discount rate for analyzing projects such as capital budgeting projects. In the past, we've been given the discount rate, but we've never looked at how to calculate it. So in Chapter 12, we'll spend some time calculating that cost of capital or discount rate. So it's the cost to a firm for capital funding, the return that the providers require of those funds. So the return that their bondholders require, the return that their shareholders require, the return that their investors require on their investment. So the return earned on those assets depends on the risk of them. A firm's cost of capital indicates how the market views the risk of those assets. A firm must earn at least the required return to compensate investors for the financing they have provided. So in order to have a net present value on a project, they must earn at least this required return, as we saw in chapters 7, 8, 9. The required return is the same as the appropriate discount rate or hurdle rate for investigating capital projects. The cost of equity is the return required by equity investors given the risk of the cash flows from the firm. So with the cost of equity, we're looking at the return on any equity investments. There are two major methods for determining the cost of equity. The first is using the dividend growth model, which we looked at in chapter 7. And the second is using the security market line or the CAPM model, which we looked at in chapter 11. So we're going to go through each one of these examples and how we do the cost of equity using these two different methods. So first, we use the dividend growth model. So with the dividend growth model formula, we rearrange the dividend growth model to solve for RE, or the required expected return. So first we have the price of a stock equals its next dividend divided by the required return minus the growth rate. We rearrange that formula and we get that the required return equals dividend 1 divided by price 0 plus the growth rate. In this example, we have a company that is expected to pay a dividend of $4.24 per share next year. Dividends have grown at a steady rate of $6 or 6% per year, and the market expects that to continue. That's our continuous growth. The current stock price is $60. So what is our cost of equity? Well, we put that information into our dividend growth model, and we get a cost of equity or a required return of 13.07%. What happens if we don't have the growth rate and we just have information about the stock that or the dividend that a company has paid over the last couple of years? In that case, we need to use their historic information to calculate a dividend growth rate. So you can see here that we have 5 years of dividend information for a company, and we use that to calculate the dividend growth between each year's dividend. And then we use that information to get an average. So that gives us an average dividend growth rate across these 4 years of 9% to use in our dividend growth model equation. The advantages and the disadvantage of our dividend growth model: the advantage is that it's easy to understand and use. The disadvantages are that we can only use it for companies that are currently paying dividends, and we know that's not true for all companies. It also doesn't work if dividends aren't growing at a reasonably constant rate that we can estimate. The required return is extremely sensitive to changes in the estimated growth rate. it does not consider risk, so we haven't done any calculation to consider risk. And it's based on estimates. So if we don't have a good estimated growth rate, then we're not getting a good estimated required return. The next method that we're going to look at is the security market line formula. So the security market line formula operates under the assumptions that equity or risk is part of the risk-free rate, the market risk premium, and the systematic risk of an asset known as the beta coefficient. So if we use the security market line formula to solve for that required equity, we get the risk-free rate plus the beta times the market minus the risk-free rate, or that market premium. So we're going to look at an example here. We have a company with a beta of 1.15. The current risk-free rate on the market is 7%, and our expected market risk premium is 6%. So what is the cost of equity capital? We get that we have a cost of equity, or required return on equity, of 9.95%. They're using 1.9 for the risk-free rate. Okay, the advantages are that then we are adjusting for systematic risk. And we can use it for any company that we have a beta for, even companies that aren't currently paying dividends. The disadvantage is that we must estimate the expected market risk premium, which does vary over time. For example, in the last slide, we were using 7% as the market rate, and that 7% market rate is based on a portfolio of a handful of stocks over a 92-year period. If we had picked different stocks or a different time period, we would have a different expected market risk. We have to estimate the beta if we don't automatically have it, and the beta also changes over time. And it relies on past information to predict the future, which is not always reliable, because we know that events can happen that change things within a day. Now we're going to look at calculating the cost of equity using both the security market line and the dividend growth model. So in the best case situation, you could calculate both of them and compare them to each other to see how far off you are with your estimates. This allows us to have higher confidence in our evidence, because if we get two similar results, then we know that our estimates are pretty on par. So we have the beta, market risk premium, risk-free rate. Our growth estimate is 8% per year. Our last dividend was $2, and our current stock price is $30. So first we use the security market line approach, and we get a 15.6% cost of equity. And then second, we use the dividend growth model approach, and we get a 15.2% cost of equity. In addition to equity, firms use debt to finance their investments. So the cost of debt is the required return on a company's debt. The first method for calculating cost of debt is to compute the yield to maturity on existing debt, so any existing bond issues. The second method is to use estimates of current rates based on the bond rating expected on any new debt that would be issued. So a firm's bond rating helps depend the expected return on their bonds, so that would be a good rate that we could use. The cost of debt is not equal to the coupon rate. So the coupon rate was the rate when the bond was issued, and if it's been 10 years since the bond was issued, that is not what the required return within the market rate is. So the yield to maturity is the more appropriate for cost of debt. So an example for calculating cost of debt is that we have a current bond issue of 22 years to maturity with a coupon rate of 7% and semi-annual coupons. Current bond price is $960. We use the yield formula to calculate the yield to maturity and get a yield of 7.37%. Using the yield to maturity on the firm's debt, we also need to look at the fact that interest is tax deductible. So the after-tax cost of debt is the return is the cost of debt times 1 minus the tax rate. So if our corporate tax rate is 20%, we would have our return on debt or a cost of debt of 7.3% times 1 minus 20.21, which is our tax rate, giving us a cost of debt, or that RD, required return on debt, after tax, that's what the AT stands for, of 5.82%. We can also look at the cost of preferred stock. So preferred stock acts a little bit more like debt than common stock. Because preferred stock pays a constant dividend every period, and those dividends are expected to be paid forever, preferred stock is a perpetuity. So we take our preferred annual dividend divided by the current price in order to get what the required return is on preferred stock, to get our cost of preferred stock. Once we have all of the component pieces, our cost of equity, our cost of debt, and our cost of return stock, we use those individual pieces or cost of capital to compute a weighted average cost of capital. So weighted average cost of capital is also called WACC, for WACC. This average is the required return on the firm's assets based on the market perception of the firm's risk. These weights are determined by how much of each type of financing is used by the firm. So first we determine the weights for the WACC. So the weights are the percentages of the firm that will be financed by each component. We always want to use the target weights if possible. If the target weights aren't available, we can use market values. So the capital structure weights, we have E, which is our market value of our equity. We calculate E by taking the number of outstanding shares times the price per share. D is the market value of our debt. This is the number of outstanding bonds times the bond price. V is the market value of the firm, which is calculated by adding the market value of our equity and the market value of debt. Then our weights are to take the market value of equity divided by the value and the market value of debt divided by the total value to determine what percent is financed with equity and what percent is financed with debt. So our WACC, we have the equity, market equity value divided by the value times the cost of equity, which is the RE, plus the percent of preferred stock in the capital structure divided by the value times the required rate of return or cost of preferred stock plus the percent of debt in the capital structure times the firm's cost of debt times 1 minus the corporate tax rate. And that is how we calculate the weighted average cost of capital. So let's look at an example. So here we have the stock price is $50. We have 3 million shares of common stock outstanding. We have $25 million in preferred stock and $75 million in debt and a 40% tax rate. So we would add all of those items together to find that we have $250 million total for the market value of the firm. We then take each, so the equity value is 150 divided by the total value. So our current weights are 60% equity, 10% preferred stock, and 30% debt. So that is the capital structure of this company. We'll then take each component, the weight of each item, times the required return of each item. So our weight of debt is 30% and our required return is 10%. The preferred stock is 10% with a required rate of 9%, and our common equity is 0.6 of our capital structure, and our rate is 14%. We put that into our WACC formula, which doesn't fit in this box, into our WACC formula, and we calculate that our weighted average cost of capital, or WACC, is 11.1%. Now, in most situations, we would use this as our discount rate when we are evaluating capital projects. So what influences what our WACC is? Market conditions. So current interest rates, current tax rates, and whatever the current market risk premium is, because all of those are used in our formula calculations. The firm's capital structure, so how are they divided up in equity, preferred stock, and dividend? That's their capital structure. Their dividend policy, because if we use the dividend growth model, that affects what our costs are of equity or preferred stock, and the firm's investment policy. Firms with riskier projects or in riskier types of business generally have higher weighted average costs of capital.